Good morning, everyone, and thank you very much for joining us for today's webinar, Making Succession Work for Your Firm. My name is Felix, and I'm the webinar coordinator at the Continuing Education Department here at the OAA. We will begin today's webinar by acknowledging the land on which we are meeting and calling in from today. For millennia, the place we call Ontario has been inhabited by Indigenous peoples and nations who have been stewards of the land and are deeply connected to its rich cultural and natural landscape. We would like to invite you in a moment of reflection to acknowledge our shared responsibility to address past and present injustices and provide space for Indigenous knowledge and worldviews to shape the architectural landscape of Turtle Island. Before we start, I would like to share some important information to ensure an effective and professional webinar experience. Please be informed that this session is being recorded for quality and educational purposes. In order to maintain a stable internet connection, we have muted all participant microphones and disabled video feeds. We highly encourage engagement through our Q&A window. Feel free to submit any questions you may have for our speaker. These will be addressed in the designated question and answer period at the end of the presentation. Kindly note, the chat function will be deactivated following this introduction. For those seeking continuing education learning hours, please note that attendance is crucial. A minimum of 80% attendance is required for these hours to be accredited to your OAA transcript. Please allow up to a few weeks for the processing and reporting of these hours. And lastly, please note that the presenter does not provide insurance, legal, or practice advice, and the OAA does not bear responsibility for errors or omissions in discussions during the webinar. For accessibility, we provide automated closed captioning service available in multiple languages to accommodate the needs of our diverse audience. But now, I'm excited to introduce you to our speaker for today's session. Please welcome Victor Carvalho.
Hi, thank you, Felix. Thank you so much for introducing us today's session. Hello, everyone. My name is Victor Carvalho. I'm an engagement manager at Innovia Partners. I have an MBA from Western University here in Ontario, master's in engineering from École Centrale Méditerranée in France. And I'm also a project management professional with certification from PMI. Unfortunately, my colleague Rowley Mossop, who is the principal at Innovia Partners, is not going to be able to join us today. So I'm going to be running this session by myself. Before we start talking about succession, I just wanted to spend a couple of minutes just introducing a little bit more about us. Both Rowley and I, we work at Innovia Partners. He founded the company in 2004, and we are a management consulting firm. We help architects, engineers, and other construction companies across Canada, UK, and in the United States as well. We help them with strategic planning, financial planning, organization design, talent management, change management, digital transformation, process improvement, business turnaround, mergers and acquisition, succession planning. So we do a little bit of everything. Over those 20 years, we have had more than 100 clients in Canada, US, and Europe, more than 200 projects with those clients. And we pretty much have this 360 degrees expertise in many different aspects of a practice, from management to design and digitalization. Our approach for succession is focused on strategy, business advice, and execution. We have helped many firms of different sizes and different types. We help them both deal with internal and external transfer of shares. And we like to not only focus on strategy and money, but also focus on people and managing talent. Our objectives for today is to gain this new perspective on what succession means, what it entails, learn more about its goals, and understand how this can be a strategic opportunity for the firm, and how we can manage some risks. Before we start diving deeper, we'd like to spend a few moments to highlight that a very important consideration, which is the fact that every firm has a different journey, every firm has a different context, people in different firms, they have different values, different ways of doing work, different ways of interacting with each other, different aspirations, different vision. So for each firm, succession planning is going to be different. It's going to require a different approach. However, there is a framework that we can use that, regardless of the unique characteristics of the firm, using the framework, we can help to plan succession in an orderly, purposeful, and strategic way. Now, we're talking about succession planning, and it's very, very important to note that the name is succession planning. It's not leadership replacement. What does it mean? It means that first, it's not a one-time experience, not a one-time event. It's not about just replacing someone by someone else and think that's going to be enough. It's not. It's succession planning. It's a process. It happens over time, and when done well, it can create capacity for creative and business growth. So again, it's not about replacing people. It's actually about building the conditions that can provide continuity in the ways that matter for the firm. And again, each firm are going to have different values and different visions. Now, what exactly does it mean? Building the conditions that can provide continuity in the way that matter. That means thinking about and answering those questions. What factors drive the firm culture and growth? What's the firm vision, and how can help the firm getting there? And who can get the firm getting there? What are the critical functional activities and roles today? How will they be different tomorrow as the business grows? What short-term actions could preserve and create future value? How to prepare new leaders and ensure a smooth change of control and ownership? What is the business strategy that will guide the company through the changes? How to retain talent that are important to run the firm, but would not be partners. That's another thing that needs to be considered. So when you think about those questions, and there are many questions, as you can see, there are two very important things you need to take away from hearing those questions. The first thing is, one, time is essential. You need time to properly think about and answer those questions. It's not a quick process. You need to get good answers. You need time to develop those answers. The second thing, thinking about those questions, the second thing you need to think about is succession is not, it's a process, but it's not a standalone process, which means it's not going to be an independent process. It's going to be a more integrated process. We're going to talk more about that very soon. But But first, let's think about the first point, which is time. Time is essential for succession planning. So it's important that you make time your friend. As you can see here, there's an image of a mountain and two people trying to climb that mountain. And you can do that in many different ways. You can get to the top in many different ways. If you choose a path, you can choose a path that is smoother, or you can choose a path that is really, really hard. It's up to you. So the same succession, likewise, it can be imagined like a mountain that can be scaled in many different approaches. And the path that is going to be easier, less arduous, and more profitable is going to be the one that starts earlier and allows for better preparation. So that's a very, very important thing for us to keep in mind. Now, the second thing is succession is not a standalone process. It's a process that happens over time, but it's not a standalone process. It must be integrated and aligned with the other elements of the business strategy. So business strategy will guide, in conjunction with the vision and core values of the firm, will guide, will help formulate the strategic goals, which will also impact the way you manage talent, workforce, the way system and process operate, the way your structure, roles and responsibilities are modeled. And in the end, this is also going to impact the results you get and the culture you have. Likewise, succession should be also considered part of the strategy. If you have a strategic approach for succession, you can incorporate succession, align it with the vision you have for the firm for the future, align with the core values, and make sure that the process of succession is going to help shape the firm's future the right way. Will help. You can use succession to shape your talent, your workforce, to shape your systems, your processes, to shape the way your teams are organized. And you can also use succession to shape and change how people perceive their roles and responsibilities. And you can use succession to reward the right behaviors and right results, helping you to shape the culture of the firm for the long run. Now, we've said that time is very, very important here when thinking about succession. So if starting early is crucial for you to achieve the desired results, why is it succession often ignored until it's almost too late? There are two main reasons. First, there is this conscious or subconscious avoidance of the emotional challenges involved in succession. Succession can be very personal, very emotional. It requires accepting that a career is coming to an end. Succession planning requires difficult choices between personal loyalty and business reality. It demands financial realism, discussing financial matters and personal goals with others. The other fact that makes people ignore succession is assuming that nothing can be done or that succession will work itself out naturally. But again, it's important to highlight here that succession requires time, effort, and a shift in focus to build the future. Owners must take control of this process intentionally and purposefully, preparing the next generation of leaders. It's very common to find an owner and that look at their peers, their colleagues, and think, well, there's no one here that I think could replace me. They're not ready, so might as well just wait. Hopefully in a few years they're gonna be ready. Now, that's the wrong mindset, because from our experience helping many firms in Canada and the UK, the next generation of leaders are never fully ready until you get them ready. If you're a company, if you're an owner, you know it's a very different mindset. It's a very different set of skills. It's a very different experience. The things you think, the things that are in your head as an owner, it's not the same things that an employee has in their mind. So it's in some ways a little bit unrealistic to expect that person to be ready to be owner, to be partner, because they've never really experienced that. So it's not about trying to find people who are ready to be owners, to be partners. It's more about creating a process to help them get them ready. That's the right question you have to answer. So instead of thinking about the question, is that person ready? The right question you should be asking is, how do we get them ready? Now, to answer this question about how to get them ready, first thing you have to understand is what makes someone a good partner. And a good partner, you can think about it as a combination of two things. One is the set of their unique traits and personal characteristics. And the other thing is their ability to assume key firm level roles and contribute to firm success. So most of the time, the candidates for the next generation of leaders and owners, there are people who have very good positive traits and personal characteristics. So this side is already good. However, most of the time they are not going to be fully ready in terms of their ability to assume key firm level roles. But the good news is this right side can be developed over time. There are many different ways through which a partner can add value to a practice. We like to think that the four main dimensions are bringing in work, which is actively acquiring new clients and projects for the firm, acting as ambassador and representing the firm externally. Firm leadership, that's another dimension, contributing to the strategic direction of the firm, sponsoring the implementation of key strategic improvements, design direction, providing the design expertise, but not necessarily being involved in the day-to-day work of the project design, more like the high-level oversight to ensure client expectations are met and projects are profitable. And lastly, the other dimension is mentorship, fostering a positive work environment and providing mentorship and developing new leaders. So those are the four key dimensions. Obviously, there are other dimensions, but we like to think of those as the core four dimensions. Now, you can identify future leaders based on their demonstrated past performance and behaviors. So you can identify people with high potential for firm leadership, mentorship, bringing in work, and project direction. However, right now, they're likely to have high potential, but not necessarily all the skills they need to succeed as partners. So unlocking their full potential is going to require intentionality so that they can transform that potential in actual skill. To get there, they need structure, training, and exposure to high value experiences that change how they approach work and how they bring value to the firm, how they see their work. So we've talked about many things. Now, a succession plan, when we start working with our clients, we like to think that a succession plan must have three components. First one is define a strategic direction, which means identifying critical functions and roles, assess growth objectives and competitive demands, set vision and direction for the company around strategic pillars. Now, this is a very important aspect because, as we mentioned before, succession is not a standalone independent process. It's an integrated process. But there's another reason why this first point is very, very important. Many succession fail because when the next generation of leaders come, they're left trying to figure out what the direction of the firm, what is the direction of the firm. So there is lots of time wasted, effort wasted, because there was no set direction for them to follow. So it's very important to clarify that vision, clarify that direction, so that when the next generation of leaders get there, they know exactly what they need to be doing. That makes everything easier in terms of business continuity, legacy continuity, design continuity. Now, the second thing a succession plan must have is a component, is a focus on developing future leaders. Again, understanding that leaders are not ready, but they can be ready. It's very important to first define what are the behaviors and capabilities that are required for being a partner. And this is important to think about because we've previously mentioned, we've talked about those 4 different dimensions, but every company is different. Every company has, they have different values, different culture, different vision, different objectives, different ways of doing things, different ways of interacting with each other. So the characteristics, a person who would be a great partner for firm A might not be the right person to be a partner for firm B if firm A and firm B are completely different in terms of culture and vision and shared values. So that's something that is very, very important to think about, outlining what it is that for that firm one would expect of a partner. And then you need to start identify key leadership candidates, people who have that high potential, as we mentioned earlier. Once you know what you want to expect of a partner for that firm, and you know the candidates, then you can then you can determine what is the gap between their skills right now versus what will be required for them when they become a partner, when it's the right time for them to become partners. So now that you know the gap, you want to start working on bridging this gap, closing this gap by creating opportunities, changing the structure, sometimes reorganizing the structure of the firm, reorganizing, rethinking roles and responsibilities so that you can expose those candidates to leadership experiences through meaningful assignments. You also want to start providing formal executive training and education. And also you want to acknowledge and reward commitment to the company growth. And again, this is a step that takes time. Now, what happens if you set a direction, you prepare your next generation of leaders, but then what happens if they, when time comes, what happens if they cannot buy shares? What if they cannot buy your company? What if they have other financial priorities? What if they think that buying a business is too risky? So there's another element of a succession planning that should be considered, which is an intentional work of convincing people, the next generation, that buying shares, that becoming partners, it is a good thing. It is financially interesting. So there is a component of educating the next generation of leaders about the financial benefits of making such investment. We want to motivate them by providing this sense of purpose and shared goals. And that's another thing that makes the first module very important too, because when there's clarity about purpose and goals, it makes them easier to, it easier to convince them to buy. And in this process of convincing them to buy, you want to start thinking about the firm's value. You want to start about creating a framework, a timeline for ownership transfer as well. Most of the time, it's very beneficial to think about ownership and control change happening over time instead of happening in just one very big transaction. The transition is much more smoother if this happens over time, and it's easier for them too, because then they can plan, make financial plans to buy shares over time. It's much easier for them as well. So succession plan must have those three components. So at the end of the day, succession is also a negotiation. In a negotiation, price is one of the most important factor. It's not the only factor. There are many other factors that are involved in a negotiation, but price is a very important one. So the process of thinking about succession, it's also going to involve estimating the value of the firm as a whole. And that's a very important work involved in this succession planning. But again, price is not the only factor, but ultimately no deal, no transaction can happen unless you're able to balance the interests of the buyer and the seller. We want to make sure the seller is receiving a fair price and the buyer is paying a fair price for the return they're going to have in the future. So knowing and acknowledging that succession is a negotiation, sometimes it's helpful to think about successors as investors. When an investor of any kind purchases shares of a firm, they are seeking financial return from the firm's future profit. So they're going to be thinking about when buying shares of a company, they're going to be thinking about the firm's portfolio of services, of the firm's competitive advantages, the pipeline of work, the quality and consistency of maintainable cash flows, the stability, governance, and structure of that firm, how efficient, productive, and profitable that firm is. So all of those things are going to be in their minds when they're gonna when making those decisions. So it's very important in the succession planning to make sure you check all the boxes, you think about ways of creating value for the succession by ensuring you can offer all of those for future buyers. Consistently high profit, well-managed firm that is not dependent on an individual partner to win work and manage the business will be worth more than one that is not. Because that's also very, very important. When people, internal buyers or external buyers, they look at your firm and they cannot easily see a firm that is running as a well-oiled machine, or when they see a company that is highly dependent on one single person, then they're going to see that, they're going to interpret that as being too risky. Too risky. So if it's too risky, then they're going to think that that business is not going to be able to generate future profit as easily. So therefore, they're going to be less attracted to make that investment. So you want to think about mitigating those risks, creating conditions, building the structure within your firm, making sure that it can be run regardless of a person, so that this perception of risk is mitigated. Now, we've talked about valuation. And the valuation is just a process that helps us to think about the firm value and put it into numbers. There are different ways of thinking about value. There's economic value, which is the first type of value. The economic value represents pretty much the capacity, it translates the capacity of the firm to generate future income into a number. A common way of getting to this economic value of a firm is analyzing the firm's future cash flow. There's a method called DCF, or discounted cash flows. So you're going to make assumptions of the firm's future cash flows, going to make assumptions about company-specific risk, industry-specific risks. You're going to make assumptions about cost of capital, so on and so on, and then you discount all the future cash flows into present, and then you're going to have a sense of the economic value of the firm. You want to think about the firm's value as the economic value pretty much every time when the firm is expected to continue to its operation after the transaction. So this is pretty much the standard. If you're thinking about valuation, you want to actually think about the economic value using this cash flow method. Now, you can also think about market value. Market value, it's the value of the firm relative to other transactions that happened with other firms that are similar to yours. So, for instance, they would use this EBITDA multiple method, and EBITDA means earnings before interest, taxes, depreciation, and amortization. So they look at a company that is very similar to yours and see how much money that firm was sold. They're gonna create a ratio between that amount of money and compare it to the EBITDA of that company. That's gonna be a ratio. And then they're gonna look at your own company and look at your own EBITDA, and then compare your own EBITDA with that ratio from a comparable company. And then you're gonna have an approximation of the value of the firm based on this comparison. This market value, it's very good for quick appraisals and for benchmarking, but it's not, as you can tell, it's not super accurate. It can give you a back of the napkin kind of a number, but at the end of the day, you want to make sure you have a valuation that captures the economic value, not an approximation market value of the firm. But it's very useful way of talking about value in early stages of the succession planning. Now, there's another way of capturing the value of the firm, which is the book value. The book value of the firm represents the total value of the assets of that firm minus liabilities and intangible assets. That's the book value. That's the value from the balance sheet. It's not really used as much unless the business is expected to be liquidated. Because when the business is being liquidated, there's no expectation for future income, future cash flow. If the business is being liquidated, the only thing you have to do, like not the only thing, but one of the options is pretty much just simply selling everything you have, paying everything you owe. So that's pretty much assets minus liabilities. That's the book value. Again, you can use market value and book value to kind of have a sense of the value of the company, but at the end of the day, the economic value is the most reliable, most used method. Now, valuation is a calculation, but the price is not necessarily value. Price is what is the result of a negotiation. Sometimes the price can be the same as the value. That will be the ideal. However, sometimes price can be higher than the value. That happens when there's a premium that can be paid for strategic or intangible advantages, like the brand of the firm, the customer loyalty, synergies, especially in the cases of mergers and acquisition, they're looking for synergies, the efficiency of management, so on and so on. So there are many intangible advantages that can be understood as premiums that is going to increase the price. This notion of premium, especially based on intangible advantages, this is, in accounting terms, this is known as goodwill. It's not most time. Most time this is assessed in a subjective manner. So it's again part of the negotiation process. But sometimes the price can be lower than the value of the company. So you're given a discount. That is usually what happens when buyers may feel risks are too hard to manage. Buyers are late in their careers with not enough time left for their investment to pay off. When buyers fear they're not going to be able to sustain the pipeline after the founding partner retires because there is a high level of dependency on the partners. And there are many other factors that might justify a discount. So it's important what we want to do here is to highlight this idea that price is not necessarily the value. It's very important to establish the value, but at the end of the day, the price is going to be the result of a negotiation. So it's going to be either higher or lower than the value. So as we start to wrap up the presentation, just want to bring a little bit of some insights from our experience. Focus on the big picture. If the practice is viable, stable, almost all succession risks can be managed if owners are clear about their strategic goals, about how they want to manage and develop their people, and they're very clear about financial expectations. We also want to highlight here that biggest success factor is remembering that goals and people are more important than money. And you can make money anytime your friend. Most practices sell their shares over a planned period of time for both strategic and financial reasons. It ensures affordability of the share sale. It allows you to implement a payment plan. And there are many different options. It gives you time to develop potential owners, financial skills and management skills, and many other firm level skills and capabilities they need to develop, as we talked earlier. It also helps to incentivize owner level performance and owner level mindset. Leverage professional support. Again, succession can be a very complex process. Few business owners, especially in the AEC industry, few business owners in the AEC, they're going to be experts in all the disciplines that are involved in selling a firm, in preparing the succession plan. You can receive guidance from many different professionals, such as a management consultant like Innovia, a chartered business valuator who's going to provide a formal, accurate description of the value of the company. You're going to need help and guidance from accountant, both in a firm, from the firm accountant, but also from your own personal accountant. And there are going to be lots of accountants involved in here. Same for lawyers. You're going to have to think about receiving legal advice from lawyers because, for instance, shareholder agreements, partnership agreements might need to be redrafted, signed again, redesigned sometimes from scratch. So you want to make sure you also have legal advice here, not only for the company, but also for the owner and for the buyer as individuals. So there are many different players here that you need to think about and manage. That is also why sometimes it's having a management consultant can help, because it's a way of making this process of coordinating different parties much easier. Today, our most important takeaway is that you can use an ownership succession strategy to build the resiliency and value of the firm now and in the long run. So thank you. Please, if you'd like to explore this topic further, I would invite you to reach out to us. You can see our principal Rowley's Mossop email and cell phone, and please feel free to reach out to us if you have any questions.
Perfect, Victor. Thank you very much for the presentation. And Victor, I think there are already a few questions posted into the Q&A window, which is also a reminder for our members. If you have any questions, please feel free to post them into the Q&A box now. Victor is going to address all questions posted there. Thank you.
Okay, sounds good. Thank you. Okay, there are some questions here that are more operational, like will the recording slides be made available after presentation? I believe the answer is yes, right, Felix?
Yes, the presentation slides will be shared with participants after the webinar, and the recording might be posted onto the OAA's YouTube channel. So if you would like to watch it again, just keep an eye out onto our YouTube channel. Okay,
fantastic. Thank you. So someone asked, who can help provide a fair and appropriate valuation of the firm? So a management consulting firm, we can look at the numbers, we can look at the financial statements, past performance, and we also look at many other things to assess the digital maturity, the quality of the work, the quality of the pipeline, the structure of the firm, and we can provide a sense, a range of where we think the valuation will land, and we usually do that to kind of guide initial conversations. However, we always, even though we can do that, we can provide a sense of a range of value. We always recommend that the firm hire a chartered business valuator to have a formal valuation, formal and impartial valuation of the firm. And that's usually the recommended approach. So again, we can do an informal general idea. We can provide an informal general idea of the value in the early stages, but then as we progress, we usually also involve a formal licensed valuator, and that's a person who can provide a fair and appropriate valuation. Answering that question. Who can help a succession candidate to assess a firm succession offer? Again, with a formal valuation provided by a chartered business valuator, with also the buyers, we always also during the process, we always invite them to seek legal and accounting advice, so that they can and that's part of the education aspect, so that they can evaluate the offer, the value of the firm, with their help. But we also make sure to highlight all the strengths and all the things we would consider as risks, so they can make very well informed decision. And usually, if a succession plan is done right, the right way, we're also able to provide the firm with a roadmap so that they can, with a roadmap with short-term actions, so that they can address some of the risks right away to create value, increase value for the transaction, and also to mitigate risks for the candidates. So that's a win-win for everyone. Do you recommend working with a handful of candidates for succession as a form of selection process? Yeah, so this is part of the process. When we identify candidates, we not only think about the next generation, but also we think about the generation after that. We like to think about the pipeline of leaders. We like to think about how can we shape the way the firm manages talent, so that you're going to have a constant flow, constant pipeline of future leaders, future generation of leaders. And that sometimes involves reshaping how the firm organize work, how the firm how they structure themselves. And more specific to your question, for the next generation of leaders, again, you want to start exposing them to high value experiences, provide training, so on and so on, incentivize them, reward them. But then this is why you also want time for succession, because sometimes you start doing this process with the candidates. Some people have really high potential, but for some reason they're not able to, or they don't want to take the next step. And this is a moment where you're going to have many opportunities, if you have time, to reevaluate how well they're progressing, and or if they're not progressing, if there's something you can do to help them, or if not, then you want to start thinking about other options. You mentioned providing formal executive training and education. What courses would you recommend? That would depend. So again, the part of the process is talking to people, identify their current skills and capabilities, and trying to understand their gaps in terms of what they need to develop. And then people are going to have different gaps, different skills, different things they need to develop. And so for each person, the courses we would recommend, they would be different. What skills or experience should we look for in those disciplines involved in selling a firm? So again, there are many skills and experiences we want to look for, and it's going to depend on the firm, the value of the firm, the vision of the firm, how do they currently work, how do they see themselves in the future. but mainly we want to look at potential in terms of business development, in terms of managing people, in terms of high quality design capabilities, so on and so on. And the goal is to focus on developing those potential and keep developing skills. Can you explain the difference between an asset purchase versus a share purchase? The benefits, I'm not sure if I completely understand this question, but a share purchase would be buying a portion of the business. So sometimes you can buy 10% of the business. So in this case, you're purchasing shares because the business is being shared. And you would have, if you buy 10%, you would have 10% of the shares of the business. And asset purchase, as there are many different ways of interpreting assets. The firm as a business entity, it has many different assets, and from an accounting perspective, equipment, building are assets, and cash is an asset. So there are many different interpretations for assets, so that I'm not really clear about your answer. But I hope that I was able to explain what share purchase means. Do you often see a mix or balancing types of valuations, economic value, market, and book value? Yeah, so we would use market value and book value early in the process, in early conversations, because it's very quick, and you don't need to make many assumptions. It's very quick, very straightforward, and gives you a quick check. But then if you want to get a more accurate value, then you want to start working on trying to figure out the economic value of the firm, which requires a little bit of time and effort because there are many assumptions, many things you need to analyze, but the result is more accurate. So at the end of the day, you short-term business valuator, they will use the economic value. That's what they do. But as I mentioned before, the price, the value is just a calculation. The price can be very different from the value. And you can use the market and book value to negotiate price, right? Because it's gonna, at the end of the day, people are gonna interpret value differently. What do you recommend for a sole proprietor who has been the primary person to procure jobs to be able to sell shares of the company's staff? So there is one of the most common issues and challenges we find, because buyers would perceive this as being too risky, because what happens when the sole proprietor leaves the firm? Who's going to be able to procure new jobs and begin new work? So that's a very high risk situation. You want to start working on that as soon as possible. Again, rethinking, identify who could be the next generation of leaders, rethinking what kind of assignments, what kind of activities and roles you can start delegating to those people, so they can slowly start being more involved with business development and procuring new jobs. And this is going to be this delegation, this share of responsibilities. In some cases requires more time. Some cases it can be done faster. It again depends on where people are in terms of skills and capabilities. Some people already naturally, they're very good communicators and very good sellers. So you could potentially leverage that if you have a person like that. That will make the process easier. Sometimes the person needs more training, and that will be one of the trainings, for instance, you could provide, coupled in conjunction with a transfer of responsibilities, involving them over time with business development opportunities. Even simple things like having them go to seminars, dinners with clients, create more long-term, make them focus on creating long-term relationship with clients and being more open to establish new connections, networking. All this stuff is very critical if to mitigate this problem, this challenge of having a high level of dependency on a sole person to procure jobs. A lot of the price asked for shares is based on future value. How long should it take for a new partner to be able to reimburse the cost of share acquisition based on profitability of the company? So again, this is going to depend on the profitability of the company. Companies with higher profits, obviously, the investment can be, you're going to pay more, but also the results might be higher. It's going to depend on the situation, on the payment plan. Yeah, there are many different aspects involved in how long the new partner would be able to break even, let's say. But usually it's not a long period. It's something that it's very very attractive. To what extent do you recommend that each party have independent teams of consultants for negotiations? So it's always recommended that each party have their own lawyer and own accountant. I don't think it'd be prudent not to have them, because this is a transaction that involves sometimes lots of money. It requires financial planning. It requires signing very important documents. So I don't think it's prudent not to have financial and legal advice. How did you determine the skill set of a partner? Was this based on the architecture practice? So yeah, so each practice, each architecture firm, they're gonna have different set of skills. There is gonna make a good partner for that specific firm. Again, each firm has their own values, their own ways of doing work, of getting work. So each company will have different set of desired skills and capabilities for partners. But in an overall generic view, we like to think about those 4 dimensions, which I mentioned. The ability to bring in new work, to be to provide firm leadership, to provide design direction, and to be a mentor. Those are four highly important dimensions. Obviously, a partner does not need to be expert in all those dimensions at the same time. If you have a bigger company, you can have a situation where one partner can complement the other, and that's also very, very interesting, a very good thing. You want at the end of the day, you want some level of diversity. It's impossible to have perfect owners with perfect capabilities in all dimensions. But regardless, it's important for them to acknowledge and recognize that those dimensions are important for the company, and if they're not be able to bring those dimensions individually, then they need to think about how those dimensions can be satisfied, let's say, as a combination of all partners as a group. When potential new owners have worked with the firm for a long time, is the value they have contributed to the firm considering the proposed sale price? Again, not necessarily, but yes and no, not necessarily. However, again, price is a negotiation. It's the result of negotiation. And it's perfectly normal to have discounted price. Sometimes this discount is given because you want to convince buyers to buy, especially when there's a situation with high risk. Or you can give discounts if you want to reward loyalty, if you want to, in a situation like an employee has been contributing for a long time, so it's perfectly acceptable to give them a discount. But again, each case is different. This is not necessarily the norm, right? It's going to depend on the firm. Are mergers of firms a good way to increase value? That seems to be the way of the present. Yes and no. Like the process of merger and acquisition, it's a very complex process. Firms do that when they're looking for synergies to increase the portfolio of services, to bring new capabilities they didn't have in a faster way than develop those capabilities in-house. So in some ways, if you acquire another firm, you're bringing in new competitive capabilities that you didn't have. So in some ways that increases value. Your cash flow is hopefully going to also be higher. So this is also going to help increase value. But then one thing that you need to think about is this merger and acquisition process, or M&A process, involves lots of complexities in terms of integrating those two firms. So there are cases where an M&A fails because they were expecting to have lots of synergies, but they ended up with a situation where there's high conflicts, very low integration, very low collaboration, very high level of redundancy. So to answer your question, yes, M&A can increase, a merger or an acquisition of a firm can increase value. Yes, however, that is assuming that this merger and acquisition, the integration process was well done. Because if it was not well done, then you're likely going to end up in a situation where the value is actually getting lower because the perception of risk is going to be higher. Do you have templates for partnership agreements for small firms? We have seen a lot of partnership agreements, shareholder agreements. We are not lawyers, but we, because we've seen so many of those agreements, we can sometimes provide informal comments on partnership agreements and point out what do we think is missing, what do we think it could be done better, and help to bridge, act like a bridge between the firm, the shareholder, the partners, and the lawyers. Because sometimes we find that sometimes our clients have really hard time talking with lawyers. They don't seem to be speaking the same language. So we do help our clients to bridge this communication gap, make this process easier, and so we are not we cannot write or draft a partnership agreement if that's what you're asking, but we are able to look at partnership or shareholder agreement and provide comments and see what's and let you know what's missing, what can be done better. What do you need to think about when and align those agreements with your succession goals and purpose? We are often approached by M&A, merger and acquisition firms from southern US states. What are the red flags or concerns in taking calls from them? What do you mean by red flag? The fact that you're being approached by M&A firms probably means that you check some of the preliminary boxes they have for potential targets, which means your business somehow attract them, which is a good thing, I guess. But there's nothing wrong about having those conversations. It doesn't mean anything. The decision about selling or not selling, selling externally and internally, that should be a decision that you want to take, considering many different aspects. It requires a very thorough consideration and conversation about whether to accept those proposals or not, but that's a very different conversation. If you could clarify your question further, I could talk more about it. How do you establish sale price if share purchase has been done over several years? Do you need to reevaluate value annually? So it also depends. We mentioned, so we're probably gonna do this first initial formal valuation done by this chartered business valuator, but then this is gonna guide the first initial conversation, the first sell and purchase of shares, let's say, but then you're also in parallel going to be working with your lawyer to rewrite the shareholders agreement, most likely, or to update an existing one. And what you can do, so instead of having to pay the valuator every time, you can specify the frequency and the method of reassessing the value of the shares over time. So sometimes you do that first initial formal valuation, and then you put in your shareholder agreements that the price is going to be updated based on the most current EBITDA or past 3 years EBITDA, like something more easy and quick that you can do just using your own account and not necessarily involving the chartered valuator all the time. That's one option. The other option is to engage with the evaluator every time. It's gonna again depend on that's gonna be the result of a conversation between accountants, management consultants, and lawyers, and the buyer and the seller to agree on what would be ideal for that situation in terms of dealing with this need for evaluating the price over time. Is there such a thing as soft succession? What does this look like, and what would be some key elements? If you could elaborate more on what you mean by soft succession, I'll be able to provide an answer for that. Would a discount constitute a dilution of share value and undone past growth of share or value? This is a very important question too, because it can create those situations. But again, this is why you want to involve lawyers and accountants, because if the discount is not done the right way, then you can certainly create this situation where the value is diluted. But there are ways of overcoming this dilution. There are mechanisms to. It's going to depend. Each case is going to be a different case. Yeah, we would advise to not give discount unless you really need to, because that would avoid many of those situations. How do you start the process of advising firm? Is there an introductory consultation? Yeah, absolutely. Again, there's always opportunity to meet and talk about the preliminary goals and needs, and identify different unique contexts and situations, and then we can start from there. Again, it's a process of in some ways it's a process of diagnosis and exploring and getting to know more about the firm and the people, and that's pretty much how it starts. And it starts with a conversation. You can email Rowley, Mossop, and we can set up a few meetings to know more about your specific challenge. Soft succession would be a structural step before partnership, for example? Yeah, so some firms they do that. Some firms they would have what they call income partners and equity partners. So that will be an example of a soft succession, as you mentioned. So a person will become an income partner. So they're gonna have like a partner title, but they're not gonna be actually a partner. They're not gonna own shares. And then if they do well as income partners, and then they can be invited to become equity partners to finally buy shares of the firm. And it's interesting. It's good for income partners because their bonuses are going to be very tied to some firm level goals and objectives. So it's a way of, again, motivating, incentivizing them to add value to the firm as a whole, and can be used as a testing grounds for formal equity partnership. Let me see if there's any other question. Is there a standard for the types of multiples for EBITDA based on whether the company is managed by owner, managed by hired director, etc., etc.? So again, this is companies well managed with a more solid, robust structure, they're gonna have higher multiples for EBITDA. In companies where there is a high level of dependency, the structure is not super solid, then you'd expect lower multiples for EBITDA. But there's no standard set in stone. It's again case by case. Okay. Any other question?
Thank you so much, Victor. That was great. If any of you members have any other questions, now is the last opportunity to post it into the Q&A window. Victor, just one last question came in. What ratios or indicators do you look for that show a successful firm?
Great question. So there are many indicators. So in terms of financial statements, P&L indicators, you can look at the net revenue, the trend, net revenue per employee. You can look at the compensation as percent of net revenue. You can look at the distribution of your expenses, like they split the breakdown of the expenses by type. You want to compare with other firms, high performing firms, to kind of assess whether you're, for instance, spending too much money on this specific thing instead of this other specific thing, for instance. You can look at profit margin. You can look at EBITDA as percentage of net revenue, the average EBITDA over the last 3-5 years. habit. Then you can also think about balance sheet KPIs like current ratio, acidity ratio, days of work in progress, average days of accounts receivable, in other balance sheet ratios, return on equity, debt and equity ratio is also another one like that helps to identify the capital structure of the business. And you can also look at other KPIs like utilization rate for the firm, utilization rate per role per employee, realization rate, overhead rate for the firm too is also interesting. The net fee multiplier. Yeah, there are many different KPIs that can be used that we use to compare a firm to its peers and get a good sense whether that firm is performing at a high level or if there's opportunities for improvement. And those are like just ratios and indicators, but there are other factors we look at more related even to project profitability, the way people organize work, the way teams are structured. We also look at the digital maturity of the firm, the level of digitalization of some key processes, including how well the data is being managed. If there's a integration of systems, if data is used properly to create reports and create numbers needed for strategic decisions. We look at the way talent is managed. So it's not only about ratios and indicators, but also all those other different non-numerical factors that is gonna give us a more solid perspective on whether or not the firm is being well managed or not. And all of this is taken into consideration when we look at value of the firm and we look at risks perceived by potential buyers. Hope that I was able to answer your question.
Great, Victor. Thank you very much. And this seems to have been the last question. So I believe we have reached the end of the webinar. Victor, thanks again very much for a great webinar and discussion today.
Fantastic. Thank you so much.
Thanks also everyone who attended. And as we conclude this webinar, I would like to draw your attention to some announcements. The next webinar takes place after the summer holidays on the 12th of September with the title Barrier-Free, Accessible or Inclusive Design. As mentioned, the OAA will report your participation in this webinar to your transcript. Therefore, there's no need for you to report it as well. We kindly ask for your patience as we process and confirm the accreditation of your hours within the next few weeks. Additionally, all attendees will soon receive the presentation file via email along with a link to submit your feedback. Once again, thank you very much for your attendance and have a productive and pleasant remainder of your day and enjoy your summer. Thanks again, Victor, very much.
Awesome.
Bye-bye.
Thank you. Thank you, everyone. Bye-bye.